Hi everyone, welcome back to my channel, or welcome if this is your first time here. My name is Caroline. I'm a investment professional working in the city of London, and today I want to give you a basic introduction and guide to investing. A little bit about me, just so that you can be a bit more comforted as to my background. I graduated law school in 2012 from Trinity College in Dublin, and then I went straight away into the investment industry, and I worked in the investment industry both in Dublin and Ireland, and the last 7 years I've worked in London, London City. I've been with my current company, even though I'm not going to mention it, I'm in my 5th year now, and that has gone quite quickly, but in a good way. So basically, I want to dispel the myth that investing is only for people with high education who come from an affluent background. No, that's not the case at all. I think it's really a crime that investing is not explained properly in schools to young people, how to structure tax efficient pooled investment vehicles. Now, just to say, I can't give investment advice as to particular stocks. That would completely conflict with my position, my job, all of that. But what I can do is explain the concepts to you so that you can go away and you can do your research. Also, if I talk about any stocks or indices or any of these products, it's just for like explaining and illustrative purposes. It's not investment advice. And also, as with all investing, capital is at risk. So now the disclaimers are out of the way, I can jump in and just say to you that don't worry if you think that this is completely an area that is not for you, because I can tell you that you're wrong. You are 100% capable of doing this, and I'm going to explain some of the concepts. So one of the first things I really want to just address in the room is that growing up, I don't know about you, but I was always told that investing is so risky and that you'd be so much better putting your money in a savings account. Now, there is risk involved in investing. However, there are different levels of risk, and there are some very low risk options that you can choose. Also, in the current market, if you look at what the average savings account rates are with banks, they're less than 1%. Whereas if you look at what the lowest risk type investments, they're usually a lot better than that. If you just look at, I'm going to talk about an index. Now, you might be saying, well, hang on a second, you're jumping too fast. What is an index? In different countries, there are lists of the top companies registered on the various stock exchanges. So if we talk about the S&P 500, it is 500 large companies that are listed on one of the US stock exchanges. So if you are investing in something that just has exposure to those top 500 companies, if you think about it, so many of them would have to do really badly to bring down your overall return. And those are the 500 largest companies. So the risk of that happening, it's not that it can't ever happen, but it's a low enough risk, in my opinion. Now, you might ask, well, hang on, if I'm going to be in a product that is exposed to this index, how has this index performed over the last 5 years? Well, you're in luck, because I have the figures right in front of me here in my trusty book. So in 2021, it returned 26.89%, and this is the S&P 500. So that was a really good year. You might be asking, okay, so that's 1 year. So if I had invested at the start of January and kept it until the end of December, you would have made a profit of 26.89%, which is no comparison to the less than 1% of a savings account. You might ask, well, what about previous years? So in 2020, it was 16%. 2019, it was 29%, which was better than 2021. In 2018, that was a year it went down by 6.24%. So it can go down as well. And in 2017, it was up by 19.42%. So you might be saying, okay, in this 5-year period, 4 times it went up significantly and 1 time it dropped. What about looking at a longer period? What about looking at the last 20 years? So the last 20 years, 3 of those years saw negative. So that includes 2018. They were 2018, 2015, and 2008. In the last 30 years, it was 7 times it's gone down. And that was, the additional ones were 2000, 2003. So if you take those figures, you can get a good idea of what the general risk is. So let's get right into this. So you're wondering, what actually is a stock or share? So Originally, they would have been issued on paper, a share certificate, and basically it's a proportion of ownership in the company to which it relates. But nowadays, it's all digitalized, but it means that you can track the performance of the company and have some exposures to the successes and the failures of that particular company. So companies that issue stocks and shares, they trade them then on an exchange, and there are exchanges all over the world, and you can see how well it does over a given period. So you might be saying, okay, well, what's the difference between stock shares? Well, there isn't really a difference between stocks and shares. They're used interchangeably. Another thing to note about if you're invested in a company's stocks or shares is you might have then exposure to dividend. You're like, hang on, what is a dividend? So basically, a dividend is when the company distributes part of its profits to the people that holds its shares. So you'll get a payment at a distribution point or the dividend point. Now, it depends how often these are distributed. You'd need to look up particularly for each company whether it gives dividends and how often, or whether it's at their discretion. That's a stock or a share. To pick out stocks and shares in particular companies, that would be considered higher risk. Now, maybe that's something you want to do. If so, great. But if you want just exposure, like I mentioned earlier, to a wider range of companies that are listed on an index, you might want to be in an exchange traded fund, or it's called an ETF. So these are bundles of shares, securities that are traded on an exchange that give you the exposure to the companies, just those companies that are listed on the particular exchange. The reason these are less risk is that you've got so many different companies in it that even if one goes down, if the others are doing well, overall, you should hopefully still be positive. Again, you need to track the individual performance of the ETF over the years, but they are considered less risk. They also have lower fees and things like that, and lower minimum amounts, in that you don't really have a minimum. You can invest as much or as little as you want in an ETF. But hang on, you might be wondering, well, are these the only type of funds? And absolutely not. If you are dealing with other funds, which are called mutual funds, this is a pool of money that investors put in, and it is managed by an investment management team who will have all these tools and research capabilities to try and pick out companies that they believe will give back positive returns over a medium to long or even short-term period, depending on the individual fund. Now, I will do more videos on actual different types of mutual funds and what you need to look out for as a retail investor, and the documents that you should look at to check fees, charges, all of these things. But for right now, I just want to keep things very high level. Management team will decide, based on what's written in the documentation relating to the fund, what to invest these in. You can still have funds that are exposed largely to an index. So there are lower risk funds and higher risk funds, but they do have to say in the documentation where their risk lies. It's called a risk indicator. But basically it means that if you're in funds, you are going to be exposed to companies that a particular investment team think are going to do well over time. We've talked about a stock and share. We've spoken about two different types of funds, which are exchange traded funds, which are lower risk, and mutual funds, which can encompass a whole range of risk levels. You might be wondering, well, hang on, I've heard speaking about bonds. What's a bond? Basically, a bond is loans, and they can be government loans, or it can be corporate bonds, which are corporate loans. And the bond will have a rating as to how risky they think the bond is. So a higher risk rating on that could mean that there's a higher chance of default of the bond, which means that some of the loans, if it's a market condition that's not great, people might struggle to pay back the loans. However, if you go for a lower risk bond, which is lower risk corporate or government bonds, it should mean really that the risk is a lot lower. And in the mutual funds I spoke about, that can have exposure to both different types of shares and also bonds, and then more complicated instruments such as those managing exchange risk. But I'm not going to really go into that now. If you are someone who has never invested before and you're thinking, hang on, there's a lot of people making money here and I just want to be part of that, well then going for a lower risk option is the best one for you. Now you're probably wondering, well, I don't know how to structure this so that it's tax efficient. Well, if you're in the UK, well, you're in luck because, well, they've had a long time the concept of an ISA, which is an individual savings account. And what that really means is that you can put in up to £20,000 a year into this ISA, and any earnings or anything from it is not taxed. Now, it is £20,000 per tax year, which runs from April each year. And it should be noted that if you don't put in all of your 20k, it's fine, but you can't carry over any unused allowance into the following tax year. So for instance, say you invested 10k one year and you thought maybe I can invest 30k the next year. That's not the case. The maximum for each tax year is £20,000. So people say, you know, to try and get the most out of it is to invest the maximum that you can. But again, that is a personal choice as to how much that you are able to invest, and I'm not going to comment on that. So basically there are 4 types of ISA in the UK, but the one I'm going to talk about today is the stocks and shares ISA. And when you're investing, you could go for that option. Now, there were the 4 types of ISAs that are there. The £20,000 limits applies across all 4. So if you have another type of ISA, as well as a stocks and shares ISA, you will need to factor that in. I mean, you can invest more into non-ISA to get exposure, but that means you will be subject to capital gains tax. So the thing you're going to say is, right, okay, so I'm going to do an ISA. I think I want to be exposed to the lowest risk I can, which are probably an ETF, exchange traded fund, rather than picking out individual stocks. How do I do this? Well, online, there are things called platforms, which basically act as your intermediary. Now, depending on the type of platform you want, there are different fees associated. I will do a separate video on the actual types of platforms and giving you the pros and cons, just facts to help you decide. What I would say though is there is plenty of online platforms and they can give you like a free stock or when you sign up to them, and the stock can be worth up to £200. You should always look though before you even sign up as to what commission they are going to charge, if any. Previously it was unheard of that platforms did not charge a commission. However, nowadays there are platforms out there that are not going to charge any commission. A few examples of this, and these are not recommendations, these are just completely these are just examples. Trading212 does not charge any commission. Robinhood does not charge any commission. Fidelity doesn't charge commission. However, Fidelity does have other types of costs. So I hope in this session it's given you just basically an idea of what a stock is, how does it work, what an index is. I've talked about funds, I've talked about exchange traded fund, and I've talked about mutual funds, which encompasses a complete different range of risks that you can pick. I've also talked about ISAs, which are your most tax efficient way and how you can really benefit from that. And then I've also talked about platforms. So guys, I think that's enough for one video. I will be delving into these in a lot more detail in videos to come, but I really hope that that has been helpful. I want you to comment and subscribe if you want to see my next video. Also tell me if you have any other questions. Again, I can't give individual investment advice, that would completely contradict my employment contract, but I can give just general facts about the investment process, which I hope will help you in your investment journey. I want everyone to feel empowered that if you want to invest and you want to take a little bit more, I suppose, calculated risk, I want you to feel empowered to do that. Thanks guys for watching. It's been a pleasure speaking to you. I'm Caroline, and take care.